Chapter 1: The Everest of Finance: Why the CFA Matters. In the towering glass cathedrals of Wall Street, the City of London, and Hong Kong's Central District, there is a quiet language spoken by those who have survived the ascent. It isn't found in a specific dialect or a secret handshake, but in three capital letters etched onto a business card: CFA. To the uninitiated, it is a professional designation. To those in the arena, it is a testament to a specific kind of intellectual fortitude. The Chartered Financial Analyst designation is not merely a certificate of knowledge, but the gold standard of an entire industry, a grueling multi-year odyssey that filters the dilettantes from the practitioners. The legacy of the Charter began with a simple, provocative idea: that the management of other people's money should be governed by the same rigorous ethical and technical standards as medicine or law. Since the first exam was administered in 1963, the program has evolved into the Everest of Finance, a mountain whose peak is often shrouded in the clouds of complex derivatives, quantitative methods, and a dauntingly thick code of ethics. It is a global equalizer. Whether you are sitting for the exam in a massive convention hall in Mumbai or a quiet testing center in New York, the questions are the same, the stakes are identical, and the passing rate remains a humbling reminder of the difficulty of the task. What draws thousands to the base of this mountain every year is the promise of what lies on the other side. In an industry often criticized for its opaqueness, the Charter serves as a universal seal of credibility. It is the master key that opens doors to elite hedge funds, sovereign wealth funds, and prestigious institutional desks. But beyond the career advancement and the salary bumps lies a deeper pull: the pursuit of mastery. To earn the Charter is to prove that you possess not just the brilliance to understand the markets, but the discipline to sacrifice 1,000 hours of your life to the pursuit of excellence. This is the starting line of that journey, a path where the only way out is through. Chapter 2: The Three Pillars: Understanding the Program Structure. The journey toward the Charter is not a sprint. It is an endurance race divided into three distinct ascending plateaus. Before you crack open a single textbook or memorize a financial ratio, you must grasp the sheer scale of the architecture you are about to climb. The program is built upon three levels of examination, each designed to strip away the superficial and demand a deeper, more synthesized understanding of the investment profession. While the curriculum cycles through the same core topics, from ethics and equity to derivatives and fixed income, the lens through which you view them shifts from the mechanical to the strategic. Level 1 is the gauntlet of breadth, a high-speed blitz through the fundamentals. Here, the challenge lies in the sheer volume of information. 10 topic areas and hundreds of learning outcome statements that test your ability to recall and apply concepts under intense time pressure. Level 2, often described as the mountain of the program, pivots toward depth and valuation. It demands that you move beyond simple formulas to perform complex analyses of financial statements and asset classes, typically organized into item sets that require nuanced judgment. Finally, Level 3 is the synthesis, the bridge to the real world. It focuses on portfolio management and wealth planning, requiring candidates to not only select the right answer, but to justify their reasoning in structured essay responses, simulating the high-stakes communication required of a professional advisor. However, the three exams are only the visible peaks of the mountain range. To earn the right to use the letters after your name, the program requires a foundation of professional maturity. This means documenting at least 4,000 hours of qualified work experience completed over a minimum of 3 years, proving that your theoretical knowledge is tempered by practical application in the investment decision-making process. From the moment you enroll and become a candidate, you are entering into a multi-year social contract with yourself. It is a roadmap that demands at least 300 hours of study per level, a rigorous enrollment process, and a commitment to a code of ethics that will govern your entire career. Understanding this structure is the first step in ensuring that when the pressure mounts, your foundation remains unshakable. Chapter 3: The ROI of the Charter. Is it right for you? Before you commit to the thousands of hours required for the Charter, you must perform a cold, calculated audit of your own motivations. In the world of finance, We are trained to evaluate every asset through the lens of its internal rate of return. Yet candidates often fail to apply this same rigor to their own career path. The charter is not a participation trophy. It is an endurance test that will demand nearly 300 hours of study per level, thousands of dollars in fees, and the sacrifice of 3 years of your social and professional life. If your why is rooted in a vague sense of obligation or the hope that a few letters after your name will magically fix a stalled career, the market will likely prove you wrong before you even reach level 2. The tangible return on investment, the salary bumps, the specialized roles in portfolio management, and the instant credibility with institutional clients is real, but it is rarely immediate. Ethics is a hurdle to be cleared, a qualitative break from the grueling quantitative rigor of financial reporting and derivative valuation. But to treat these standards as mere exam fodder is to miss the heartbeat of the entire program. The charter is not just a certification of intelligence, it is a vow of stewardship. It is the recognition that behind every decimal point in an asset allocation and every ticker symbol in a portfolio lies a human story. A retiree's security, a child's education, or a family's legacy. The investment profession operates in a realm of inherent asymmetry, where the practitioner often possesses far more information than the client. This gap is where profit can be made, but it is also where trust can be broken. The CFA Institute's focus on integrity isn't a decorative addition to the curriculum. It is the industry's immune system. Without a rigorous ethical framework, the markets cease to be engines of economic growth and instead become predatory landscapes where the loudest or most deceptive voices win. As you navigate the complexities of soft dollars, fair dealing, and material non-public information, you are not just learning how to avoid a violation. You are learning how to build a foundation that can withstand the inevitable pressures of a high-stakes career. True integrity in investment is rarely about choosing between a clear right and an obvious wrong. Instead, it is found in the gray areas, the subtle moments where personal interest whispers against the client's best outcome, or where a shortcut promises an easy gain at the cost of transparency. The Code of Ethics serves as your North Star in these moments of professional fog. It demands a level of loyalty and prudence that goes beyond the letter of the law, pushing the practitioner toward a higher standard of excellence. As you dive into the nuances of these standards, remember that your reputation is the only asset you cannot reacquire once it is lost. Mastering this chapter is about more than passing the exam. It is about deciding what kind of professional you intend to be when nobody is watching. Chapter 5: The Level Wine Gauntlet. building the foundation. If level 1 of the CFA program were a physical landscape, it wouldn't be a narrow, bottomless crevasse. It would be a vast, shimmering ocean that stretches toward every horizon. The challenge here is not necessarily one of complexity, but of sheer staggering scale. You are expected to transform into a polymath overnight, pivoting from the intricate mechanics of fixed income valuation to the ethical nuances of professional conduct, and then to the foundational principles of microeconomics. At this stage, depth is a luxury you cannot afford. Level 1 is a war of attrition, fought on a front that is thousands of miles wide, and your primary objective is to build a foundation that is stable enough to support every advanced concept that follows. Success in this initial gauntlet requires a shift in your intellectual DNA. Many candidates approach the curriculum with the perfectionist mindset that served them well in university, attempting to master every formula and footnote in the 1,000-page volumes. This is a trap. To navigate level 1, you must embrace the art of tactical triage. You are not trying to become a PhD in any single subfield. You are trying to achieve a working literacy across 10 distinct disciplines. The goal is to build a wide, sturdy platform. If you spend 3 weeks obsessing over the minutiae of deferred tax assets at the expense of understanding the basic framework of financial statement analysis, the ocean will swallow you whole. The secret weapon in this campaign is the pivot from passive reading to aggressive application. While the curriculum is the map, the mock exam is the terrain. Many candidates wait until they feel ready to take a practice test, a day that, for most, never actually arrives. In reality, the mock exam strategy should be the heartbeat of your study plan. These 4-hour simulations are not merely diagnostic tools, they are the most efficient teachers you have. They strip away the abstraction of the textbooks and force you to confront the visceral reality of the clock and the ambiguity of the questions. By exposing your blind spots early and often, you stop being a student of the material and start becoming a master of the exam itself. Chapter 6: The Language of Data: Mastering Quantitative Methods. The quantitative ecosystem of the CFA curriculum is often viewed by candidates as a formidable wall of Greek letters and complex notations, a high-altitude barrier that separates the analysts from the aspirants. Yet, underneath the daunting exterior of standard deviations and p-values lies the foundational grammar of modern finance. To master quantitative methods is not merely to engage in a mechanical exercise of button pushing on a Texas Instruments calculator. It is to learn the language of probability and logic that allows an analyst to speak authoritatively about a world defined by uncertainty. Without these tools, a financial report is little more than a collection of anecdotes. With them, it becomes a rigorous interrogation of reality. We begin with the time value of money, TVM, the heartbeat of all financial theory. It is the simple but profound acknowledgement that a dollar today is not a dollar tomorrow, a concept that serves as the DNA for every valuation model you will ever build. Whether you are calculating the present value of a corporate bond or the future funding requirements of a pension plan, TVM is the ultimate arbiter of worth. Mastering this section requires moving beyond the formulas to understand the why behind the discounting process. Once the internal logic of compounded growth becomes intuitive, the rest of the quantitative curriculum begins to lose its capacity to intimidate. Transitioning from the certainty of TVM into the realm of statistics and probability is where many candidates feel the ground shift beneath their feet. Here, we move from the clinical precision of a singular answer to the nuanced landscape of expectations and distributions. In this domain, we learn to quantify risk through the lens of the normal distribution and to test our assumptions using the scientific rigor of hypothesis testing. We are no longer just looking at what happened, we are determining the likelihood of it happening again. This is the backbone of the curriculum because it provides the filters through which we view all other data, teaching us to distinguish the meaningful signals of market performance from the inevitable noise of a chaotic financial system. Chapter 7: Mapping the Macro: Economics for Analysts. To the uninitiated, the economics section of the curriculum often feels like a sprawling academic detour, a dense thicket of supply curves and central bank mandates that seems miles removed from the visceral thrill of a stock pitch. But for the serious analyst, macroeconomics is not a distraction. It is the atmosphere in which every valuation breathes. You can build the most intricate discounted cash flow model in the world, but if you fail to account for a shifting interest rate environment or a cooling global manufacturing index, your projections are little more than sophisticated guesswork. Mapping the macro is about recognizing that no company exists in a vacuum. Every balance sheet is tethered to the gravity of the broader economy. Bridging the gap between theory and practice requires a shift in perspective. In the examination hall, you are asked to calculate the elasticity of demand or the impact of a tariff. In the real world, you are asked to determine how those forces will erode a company's operating margins over the next 3 fiscal quarters. The true test of an analyst lies in their ability to translate a headline about consumer price indices into a concrete investment thesis. When the Federal Reserve pivots, it doesn't just change a number on a screen. It recalibrates the cost of capital for every startup in Silicon Valley and every infrastructure project in emerging markets. Understanding this ripple effect is what separates a technician from a strategist. At the micro level, the focus narrows to the mechanics of the firm and the industry. Yet the principles of supply and demand remain the ultimate arbiters of value. Analysts must become forensic detectives of market structure, identifying the moats that allow a firm to maintain pricing power even when inflationary pressures mount. Is the business a price taker or a price maker? Can it pass on rising input costs to a loyal customer base, or will its margins be crushed by the invisible hand of competition? By mastering these economic drivers, you move beyond the what of financial reporting and into the why of asset valuation, gaining the clarity needed to navigate a global market that is as volatile as it is interconnected. Chapter 8: Decoding the Books. The Art of Financial Statement Analysis. To the uninitiated, a set of financial statements looks like a dry ledger of historical facts, a stagnant record of money moving from one bucket to another. But for the aspiring charter holder, these documents are less like a history book and more like a crime scene. Financial Statement Analysis, FSA, is perhaps the most formidable gauntlet of the early exams because it demands a shift in perspective. You are no longer just a student memorizing definitions. You are a forensic investigator tasked with determining whether a company's reported health is a reflection of economic reality or a masterpiece of accounting fiction. The complexity of FSA lies in the gray areas between the lines. While the balance sheet must always balance, the truth behind the numbers is often subjective, shaped by management's choices in depreciation methods, inventory valuation, and the timing of revenue recognition. Level 1 teaches you the mechanics, the plumbing of debits and credits, but Level 2 demands that you see the leaks. You must learn to strip away the veneer of aggressive accounting to find the core earning power of the business. It is a process of translation, converting the rigid language of GAAP or IFRS into the fluid reality of future cash flows. Mastering this section requires more than just a calculator. It requires a healthy dose of professional skepticism. As you navigate the intricate web of deferred tax assets, pension liabilities, and off-balance sheet entities, your goal is to identify the quality of earnings. A company can show record profits on paper while bleeding cash in reality. To bridge this gap, you must develop an instinct for where companies hide their weaknesses and how they polish their strengths. By the end of this chapter, you will stop seeing the books as a collection of static figures and start seeing them as a living, breathing narrative of a company's competitive survival. Chapter 9: Equity Analysis: Finding Intrinsic Value in a Crowded Market. In the relentless hum of the global markets, price is a loud, distracting constant. It flickers across terminals in neon green and red, reacting to headlines, whispers, and the collective anxiety of millions. But for the equity analyst, price is merely a noisy neighbor. The true objective lies beneath the surface, buried in the fine print of 10Ks and the rhythmic pulse of cash flow statements. Finding intrinsic value is less about predicting where a stock will trade tomorrow and more about determining what a business is actually worth today if you were to own every Bolt, brand, and bank account it possesses. It is the art of seeing the signal through the static, a discipline that requires both the rigor of a mathematician and the skepticism of an investigative journalist. The journey into fundamental valuation begins with the dividend discount model, DDM, a classic framework that views a stock not as a speculative chip, but as a claim on a stream of future income. This model is the bedrock of finance, teaching us that the value of an asset is the present value of all future cash it will provide to its owners. However, in a modern market where high-growth tech giants often hoard capital or pivot toward share repurchases, the DDM is often just the starting point. To truly navigate the complexities of a crowded market, the analyst must master the free cash flow to the firm, FCFF model. This approach strips away accounting mirages to focus on the cold, hard cash left on the table after the bills are paid and the business has reinvested in itself. It is the ultimate measure of corporate health, revealing whether a company is an engine of wealth creation or a sinkhole for investor capital. Yet, numbers in a vacuum can be misleading. A stock that appears cheap on a spreadsheet might be a value trap, while a richly priced innovator might actually be a bargain when viewed through the lens of its peers. This is where relative valuation multiples, such as PE, EV/EBITDA, and price to book, enter the fray. These tools allow us to benchmark a company against its industry rivals, providing a necessary reality check to our internal projections. The challenge of equity analysis lies in the synthesis of these methods. It is a balancing act of weighing historical performance against future uncertainty, ensuring that when the market finally corrects its mispricing, you are already positioned where the value truly resides. Chapter 10: The Debt Market: Mastering Fixed Income Securities. To the uninitiated, the fixed income market often lacks the adrenaline-soaked allure of the equity pits. While stocks capture the headlines with their meteoric rises and gut-wrenching crashes, the debt market is frequently dismissed as the boring sibling of the financial family. This is a dangerous misconception. In reality, the bond market is the bedrock of the global financial system, a massive, intricate machinery that dictates the cost of capital for everything from a family's mortgage to a superpower's infrastructure project. Mastering the charter means moving beyond the surface-level simplicity of lending money and delving into the cold, mathematical elegance of bonds, where every basis point is a battlefield. At the heart of this discipline lies the yield curve, a visual representation of time, risk, and expectation. It is the closest thing a finance professional has to a crystal ball, signaling whether the economy is gearing up for a sprint or bracing for a recession. To navigate it, you must become fluent in the language of duration and convexity, not just as formulas to be memorized for the exam, but as tools to measure the sensitivity of your portfolio to the shifting winds of interest rates. You are essentially learning to calculate the gravitational pull that macroeconomics exerts on a piece of paper, balancing the promise of steady income against the relentless erosion of inflation. However, the mechanics of interest rates are only half the battle. Fixed income analysis is equally a study of human and institutional fragility, encapsulated in the rigors of credit analysis. When you buy debt, you are betting on the borrower's ability to remain solvent through the myriad of black swan events that the future inevitably holds. This chapter deconstructs the architecture of credit spreads and the fine print of bond covenants, teaching you to look past a pristine balance sheet to find the hidden cracks in a company's foundation. In the debt market, you don't win by finding the next moonshot. You win by accurately pricing the probability of failure. Building proficiency in fixed income requires a shift in mindset from optimism to skepticism. While equity investors look for growth, bondholders prioritize preservation and the certainty of the coupon. As we explore the complexities of credit ratings, the nuances of securitization, and the volatility of the secondary markets, keep one principle at the forefront. In the world of bonds, there is no room for ambiguity. Precision is your only shield against the inherent risks of the debt market, and mastery of these instruments is what separates a true investment professional from a mere speculator. Chapter 11: The Level 2 Beast: Mastery of Asset Valuation. If Level 1 was a sprint across a vast, shallow lake, Level 2 is a deep-sea dive into a trench where the pressure mounts with every meter. The broad, conceptual questions that define the first stage are gone, replaced by the item set, a dense, multi-page narrative known as a vignette. You are no longer asked to simply identify a formula. You are expected to inhabit the role of an analyst, buried in the footnotes of a complex financial statement, tasked with untangling the threads of valuation in a world where data is messy and the correct answer is buried beneath layers of nuance. This is where the sheer volume of material gives way to an agonizing degree of depth, and where many of the most promising candidates find their journey abruptly halted. The shift in logic is jarring. Level 2 demands a mastery of asset valuation that goes beyond rote memorization of the CAPM or the Gordon growth model. Here you are forced to reconcile the theoretical elegance of finance with the gritty reality of accounting adjustments, pension liabilities, and intercorporate investments. The exam doesn't just ask you what a company is worth. It asks you to defend the very mechanics of that value, challenging your ability to perceive how a slight change in a terminal value assumption can ripple through an entire valuation model. It is a psychological war of attrition, where the hurdle isn't just the content, but the stamina required to remain precise while navigating thousands of words of dense technical prose. To survive the beast, one must undergo a fundamental shift in perspective. You can no longer afford to be a passive consumer of information. You must become a practitioner of the craft. Level 2 is designed to filter out those who can merely recite a textbook from those who can apply rigorous analytical frameworks to idiosyncratic problems. Every vignette is a puzzle designed to test not just your knowledge, but your judgment. Mastery here means learning to ignore the noise of irrelevant data and zeroing in on the single pivotal variable that shifts the needle. It is the most grueling stage of the charter's path, but it is also where a true financier is forged. Chapter 12, Derivatives and Risk, Tools for Modern Hedging. The financial world often treats derivatives with a mixture of reverence and dread, labeling them as everything from essential surgical tools for risk management to financial weapons of mass destruction. Yet, stripped of the hyperbole, a derivative is simply a contract whose value is tethered to something else: a stock, a bond, a commodity, or even the weather. In the context of the Charter, mastering derivatives is not about complex calculus for its own sake. It is about understanding the mechanics of certainty. It is the art of pinning down a future price today to ensure that the volatility of tomorrow does not capsize a global portfolio. To the uninitiated, the landscape of forwards, futures, swaps, and options can feel like a labyrinth of synthetic complexity. However, each instrument serves a distinct strategic purpose in the modern hedger's toolkit. A forward contract is a private handshake in the dark, a bespoke agreement to exchange assets at a set price that relies entirely on the integrity of the counterparty. A future takes that same handshake and moves it into the bright light of an exchange, standardizing the terms and eliminating credit risk through the rigorous, daily discipline of margin calls. These are the linear building blocks of finance, designed to lock in a trajectory and eliminate the guesswork of market swings. Where forwards and futures are obligations, options introduce the elegant concept of choice. An option is the ultimate insurance policy for a portfolio manager, providing the right, but not the requirement, to act. It allows a sophisticated investor to participate in the upside of a market move while setting a hard floor against the abyss of a downturn. Combined with swaps, which allow institutions to trade streams of interest rates or currencies as easily as one might trade baseball cards, these instruments form a multidimensional grid. Together, they allow a fund manager in London to hedge against a drought in the Midwest or a currency devaluation in Tokyo, transforming unpredictable global chaos into a manageable, calculated set of risks. Chapter 13, Beyond Stocks and Bonds, Alternative Investments. The traditional portfolio, a clean, binary split between the vibrant volatility of equities and the steady, rhythmic pull of fixed income, was once the gold standard of investment theory. For decades, the goal was simple: find the right balance between the two and ride the tide of the broader market. But as you progress through the higher levels of the Charter, that binary world begins to dissolve. You are introduced to a shadow realm of finance, a collection of assets that refuse to be categorized by stock tickers or coupon rates. This is the domain of alternative investments, a diverse landscape where the barriers to entry are high, the liquidity is low, and the potential for alpha is hidden in the complexities of the unconventional. Venturing into alternatives like private equity, real estate, and commodities requires a fundamental shift in your analytical lens. Unlike the transparency of a public exchange, where prices flicker every second, these assets often live in the stale air of infrequent valuations and private negotiations. Analyzing a multi-billion-dollar leveraged buyout or a sprawling commercial real estate portfolio isn't just about crunching numbers. It's about understanding the underlying physical and operational realities. You aren't just buying a share of a company, you are often betting on a specialized manager's ability to overhaul a business model or navigate the granular cycles of local property markets. Furthermore, the allure of alternatives lies in their promise of diversification, the free lunch of finance. When the global equity markets take a synchronized dive, the Charter teaches you to look for assets that march to their own beat. Whether it is the inflation hedging power of physical commodities or the long-term illiquid horizon of venture capital, these instruments provide a buffer against the traditional market's systemic shocks. However, this diversification comes at a cost. To master this section of the curriculum, you must become comfortable with the trade-offs: the loss of daily liquidity, the opacity of black box hedge fund strategies, and the rigorous due diligence required when there is no public prospectus to catch your fall. As you navigate this chapter, think of yourself less as a passive trader and more as a detective. The standard tools of the trade, standard deviation and beta, often fall short when applied to the skewed, fat-tailed distributions of non-traditional assets. You will learn to look for the nuances of dry powder, the intricacies of cap rates, and the structural complexities of carried interest. In the modern financial landscape, being a generalist is no longer enough. To carry the Charter, you must be able to bridge the gap between the familiar world of stocks and bonds and the sophisticated high-stakes frontier of the alternative universe. Chapter 14. The Level 3 Final, the Synthesis of Portfolio Management. If Levels 1 and 2 were about the microscopic examination of the engine's components, valuing the gaskets, testing the pistons, and measuring the fuel concentration, Level 3 is about getting behind the wheel and driving the car through a storm. The shift is jarring. You are no longer asked to merely calculate the intrinsic value of a single security or identify an accounting anomaly. Instead, you are thrust into the role of the architect. The exam demands a transition from granular analysis to holistic synthesis, requiring you to weave disparate threads of equity, fixed income, derivatives, and economics into a single, cohesive tapestry of portfolio strategy. At this final stage, the client is no longer a theoretical construct, but a complex entity with a balance sheet and a heartbeat. Whether you are managing the multi-generational wealth of an individual or the sprawling liabilities of a defined benefit pension plan, the objective shifts from "what is this worth" to "how does this fit?" You must learn to view the world through the lens of the Investment Policy Statement, IPS, a document that acts as both a constitution and a roadmap. Every decision you make is now subservient to the unique constraints of time horizons, tax burdens, and liquidity needs, transforming the cold logic of finance into the nuanced art of wealth planning. The true challenge of Level 3 lies in the construct, monitor, and rebalance cycle. It is a test of your ability to think in 3 dimensions, balancing the mathematical elegance of mean variance optimization with the messy reality of behavioral biases. You are tasked with synthesizing the macro environment with the micro needs of the portfolio, ensuring that every asset class serves a specific purpose in the pursuit of a long-term goal. As you approach this final hurdle, your focus must move beyond the equations and toward the bigger picture, the mastery of the synthesis that defines a true investment professional. Chapter 15. The Candidate's Mindset, Psychological Fortitude and Grit. The CFA Charter is not an IQ test. It is a war of attrition. While the curriculum demands a certain level of quantitative fluency and analytical rigor, the real hurdle is the sheer, unvarnished volume of material that must be digested over a minimum of 900 cumulative hours. Intellectual curiosity might get you through the first few modules of ethics and equity, but it is psychological fortitude that drags you across the finish line. When it's 11 p.m. on a rainy Tuesday, your friends are out at a bar, and you're still staring at a complex pension accounting formula that refuses to stick. To survive this journey, you must stop viewing yourself as a student and start viewing yourself as an endurance athlete preparing for a marathon that lasts 3 to 5 years. The most insidious enemy you will face is not the difficulty of the derivative readings, but the slow, corrosive effect of social isolation and cognitive burnout. The charter demands a level of sacrifice that is often invisible to those outside the industry. You will miss birthdays, decline weekend getaways, and become a ghost in your own social circles. Over time, this creates a psychological shuddering effect where the world feels small, confined to the glow of a desk lamp and the scent of highlighter ink. Maintaining your mental health during this period requires more than just powering through. It requires a deliberate strategy for emotional preservation. You must learn to distinguish between the healthy fatigue of a productive study session and the dangerous, hollowed-out feeling of burnout that leads to total surrender. True grit in the context of the CFA program is the ability to maintain a high level of execution when the novelty has long since vanished. Motivation is a fickle friend. It will be there in January when you buy your new books, but it will vanish by the sweltering heat of May. To bridge that gap, you must build a fortress of discipline that functions independently of how you feel on any given day. This means viewing the 300 hours per level not as a mountain to be climbed, but as a series of non-negotiable daily transactions. You trade your leisure for progress, your comfort for competence. By the time you sit for the exam, your success will not be determined by a sudden burst of brilliance in the testing center, but by the quiet, resilient mindset you cultivated during the hundreds of hours when no one was watching. Chapter 16: The 300-Hour Rule. Strategic Study and Time Management. The 300-hour rule is often whispered in the corridors of investment banks and asset management firms as if it were a mystical incantation, a guaranteed threshold for success. However, the raw tally of hours is a deceptive metric. In the high-stakes theater of finance, where 70-hour work weeks are the baseline, simply finding time is not the objective. Engineering it is. You are not just a student. You are a professional athlete of the intellect, forced to train in the margins of a grueling career. To survive this, you must stop viewing study time as a sedentary chore and start treating it as a high-yield investment. If you are going to sacrifice your mornings, your weekends, and your sanity, you cannot afford to spend that currency on passive reading or the polite highlighting of textbooks. True mastery of the curriculum requires a departure from the linear learning models of university. You must embrace the friction of active recall. While it is comforting to glide a yellow marker over a complex derivative formula, that comfort is a siren song leading toward failure. Active recall demands that you close the book and force your brain to retrieve the information from the void. It is the difference between recognizing a face and recalling a name. One is easy, the other is cognitive weightlifting. By forcing your neurons to fire without the safety net of the page, you are building the mental muscle required to synthesize vast amounts of data under the crushing pressure of a timed exam environment. This cognitive strain must be paired with the clinical precision of spaced repetition. The human brain is a leaky bucket, and the forgetting curve is an unforgiving reality for any candidate trying to retain ethics, equity, and fixed income simultaneously. Rather than cramming a single topic for 10 hours, only to watch it evaporate by the following Tuesday, you must distribute your exposure over expanding intervals. This strategic cadence ensures that you are revisiting concepts precisely at the moment they begin to fade. It transforms your study schedule from a desperate race against time into a disciplined rhythm of reinforcement, turning the 300-hour requirement from a daunting mountain into a series of calculated, manageable steps. Ultimately, balancing a full-time finance role with this level of academic rigor is an exercise in ruthless optimization. You must learn to exploit the pockets of your day. The commute, where you drill flashcards, the lunch hour, dedicated to 50 practice questions, and the pre-dawn window before the markets open when your mind is sharpest. This is not just about time management, it is about energy management. By utilizing these frameworks, you move beyond the brute force of putting in the time and begin to engage in the kind of strategic preparation that separates those who merely sit for the exam from those who actually earn the charter. Chapter 17, The Evolving Analyst, AI, Big Data, and ESG Investing. For decades, the image of the financial analyst was defined by the green-tinted glow of a spreadsheet and a stack of printed annual reports. Success was measured by the ability to deconstruct a balance sheet and master the mechanics of the dividend discount model. But today, the silence of the library has been replaced by the hum of the server room. The modern analyst no longer just sifts through data. They must navigate a deluge of it. The curriculum has shifted to acknowledge a fundamental truth. The tools of yesterday are no longer sufficient to decode the markets of tomorrow. Python scripts and machine learning algorithms are moving from the periphery of the fintech world into the very heart of the charter, transforming the way we identify alpha in an increasingly automated landscape. This evolution is not merely technological, but philosophical. As big data provides the how of modern investing, the rise of ESG, environmental, social, and governance factors, provides the why. Institutional capital is no longer agnostic to the world it inhabits. It is increasingly directed by a mandate to account for climate risk, social equity, and corporate ethics. For the CFA candidate, this means moving beyond the narrow confines of quarterly earnings to understand how a carbon footprint or a boardroom's diversity can impact a firm's long-term valuation. Integrating these non-financial metrics isn't just about doing good. It's about a more sophisticated understanding of risk management in a world where a single social media firestorm or regulatory shift can erase billions in market cap overnight. Staying relevant in this new era requires a dual fluency. You must remain a master of the core financial principles, the bedrock of the charter, while simultaneously becoming a translator between the old world and the new. The evolving analyst is one who can bridge the gap between a machine learning model's output and a client's fiduciary goals. Someone who can see the narrative hidden within petabytes of unstructured data. As the exam evolves to include modules on data science and sustainable finance, it sends a clear message. The charter is not a static monument to the past, but a living map designed to help you navigate a financial frontier that is being rewritten in real time. Chapter 18. Leveraging the letters, career paths after the charter. The moment the official confirmation hits your inbox, the 3 letters CFA feel less like an academic designation and more like a hard-won inheritance. But the charter is not a trophy meant to collect dust on a mahogany shelf. It is a high-octane fuel that requires a specific engine to produce results. For years, you have been defined by what you were studying. Now you must redefine yourself by what you can execute. The transition from candidate to charter holder demands a strategic pivot from the internal grind of the library to the external theater of the global marketplace. Your first move isn't just updating a signature line, it is a total recalibration of your professional identity. Refining your resume to reflect this new status requires more than a simple line item under the education section. To a hiring manager, the charter acts as a universal solvent for doubt regarding your technical competency and ethical grounding. However, you must leverage this signal to bridge the gap between where you are and where you intend to go. If you are eyeing a move from back-office operations to the front-office buy-side, the charter is your bridge. Your profile should no longer highlight the tasks you performed, but rather the rigorous analytical framework you now possess to solve complex valuation riddles. You are no longer selling your potential. You are selling a vetted, global standard of excellence. Beyond the paper trail lies the CFA Institute's most undervalued asset, the Global Member Directory. This is not merely a database. It is an elite map of the financial world's inner sanctum. For the first time, you have a legitimate in with portfolio managers, chief investment officers, and analysts in every major financial hub from Singapore to Zurich. Networking post-charter changes the power dynamic of the conversation. When you reach out to a fellow member, you are not a stranger asking for a favor. You are a peer who has survived the same crucible. The shared language of the curriculum creates an instant rapport that bypasses the friction of traditional cold calling. Finally, the true value of the charter is unlocked through active participation in your local society. These chapters serve as the crucibles where the theory of the curriculum meets the reality of the markets. Engaging in society events, whether through committee work, mentorship programs, or speaker series, transforms those three letters into a living, breathing network. The job market at the highest levels of finance is rarely found on public boards. It is discussed over coffee after a forecast dinner or whispered during a continuing education seminar. By positioning yourself at the center of this ecosystem, you ensure that the effort you poured into the exams pays compounding dividends for the rest of your career. Chapter 19: The Human Element. Behavioral finance and market biases. The financial world likes to imagine itself as a grand, interlocking machine of cold logic and perfect efficiency. We are taught to worship at the altar of the rational actor, a mythical creature who processes data with the precision of a supercomputer and never lets a heartbeat interfere with a trade. But as you transition into level 3 of the program, the curriculum strips away this clinical veneer to reveal the messy, thumping heart beneath the spreadsheets. You realize that the market isn't just a collection of tickers and price discovery mechanisms. It is a chaotic ecosystem of human hope, fear, and intellectual vanity. Behavioral finance is the study of why smart people do deeply irrational things with their money. It challenges the bedrock of modern portfolio theory by suggesting that the efficient market is often a mirage created by our collective neurological shortcuts. In these chapters, the charter asks you to step away from the calculator and into the psychologist's chair. You learn that we are all burdened by an evolutionary inheritance that is poorly suited for the modern exchange. We chase winners because our ancestors chased the herd to safety. We hold on to losing positions because our brains process the sting of a financial loss with more intensity than the joy of an equivalent gain. Mastering this section of the candidate body of knowledge requires a painful level of self-awareness. It is one thing to identify a bias like overconfidence or mental accounting in a case study. It is quite another to recognize it in the mirror when your own capital is on the line. The charter demands that you deconstruct your own decision-making framework, forcing you to acknowledge that your conviction might actually be confirmation bias in disguise. To navigate the toughest exams in finance, you must first learn to navigate the labyrinth of your own mind, ensuring that when the market turns volatile, you are the one observing the panic rather than participating in it. Chapter 20: Standardizing Success. Global Investment Performance Standards, GIPS. In the high-stakes arena of asset management, performance is the only currency that truly matters. Yet, before the advent of the Global Investment Performance Standards, GIPS, that currency was often devalued by a wild west of reporting practices. Firms were free to cherry-pick their best-performing accounts, ignore those that folded under pressure, and manipulate time periods to paint a picture of success that was more mirage than reality. Trust, the foundational bedrock of any fiduciary relationship, was being eroded by a lack of comparability. Investors found themselves comparing apples to oranges, or worse, attempting to decipher a ledger where the rules of arithmetic seemed to shift depending on who was holding the pen. The GIPS standards were born out of a desperate need for a universal language, a global gold standard that would level the playing field. To understand GIPS is to understand the ethical backbone of the investment profession. These standards are not merely a set of accounting hurdles. They are a commitment to full disclosure and fair representation. By mandating how composites are constructed and how returns are calculated, GIPS ensures that a firm's track record is a transparent reflection of its actual history, rather than a curated highlights reel. For the candidate, mastering these requirements means learning how to safeguard the industry's most precious asset, institutional integrity. Navigating the intricacies of GIPS requires a shift in mindset from simple calculation to rigorous compliance. It involves moving beyond the what of investment returns to the how, ensuring that every calculation is timely, consistent, and inclusive of all fee-paying discretionary portfolios. Whether you are analyzing input data requirements or the nuances of composite maintenance, the objective remains the same: to provide prospective clients with a reliable basis for comparison. In a globalized market where capital flows across borders at the speed of a keystroke, adhering to these standards is no longer just a best practice. It is the prerequisite for professional credibility and the primary defense against the distortions of the past. Chapter 21: Voices from the Field: Diverse Roles Within Investment Management. The bridge between the final exam and the first day of a new career is often paved with a singular question: now that I have the letters, where do I actually go? For many, the CFA charter conjures a narrow image of a fund manager hovering over a Bloomberg terminal, but the reality of the industry is far more expansive. It is a sprawling ecosystem where different temperaments find their professional homes. Whether you are energized by the high-stakes narrative of the markets or find your flow in the granular precision of data, the investment management landscape is built to accommodate a vast spectrum of intellectual curiosities. On the sell side, the air is thick with the urgency of communication. Here, equity research analysts act as the industry's journalists and forensic investigators, tireless in their pursuit of the why behind a stock's valuation. They are the ones dissecting quarterly earnings calls and visiting factory floors, distilling complex corporate movements into actionable ratings for the broader market. It is a role defined by visibility and persuasion, a constant test of one's ability to defend a thesis against a tide of skeptical institutional clients. If the sell side is about broadcasting insight, the buy side is about the quiet, heavy responsibility of ownership. Portfolio managers and buy-side analysts at pension funds or private equity firms operate in a world of conviction, where the ultimate metric is not just the quality of the report, but the realized return on the capital entrusted to them. Beyond the traditional tug-of-war between buying and selling lies the essential machinery of risk management and alternative investments. In these corridors, the charter serves as a common language for those tasked with guarding the gates. Risk managers work as the sober conscience of the firm, utilizing sophisticated quantitative models to ensure that a sudden market spasm doesn't turn into a catastrophic collapse. Meanwhile, in the rapidly expanding realm of private markets and ESG, environmental, social, and governance, investing, the CFA toolkit is being applied to assets that don't trade on an exchange. From the high-octane environment of a multi-strategy hedge fund to the mission-driven halls of a sovereign wealth fund, the path you choose is rarely a straight line, but rather a reflection of how you prefer to solve the infinite puzzle of the global markets. Chapter 22: A Global Passport: Networking Within the CFA Society. Once the dust settles from the final exam and the letters finally appear behind your name, you realize that the charter is far more than a certificate of vocational competency. It is a key to a silent, global boardroom. Whether you are in a skyscraper in New York, a boutique firm in Geneva, or a burgeoning startup hub in Ho Chi Minh City, the designation acts as a universal dialect. It signals more than just technical proficiency. It signals a shared ordeal. When you meet a fellow charter holder, there is an unspoken understanding of the thousands of hours sacrificed at the altar of the curriculum. This shared trauma, transformed into triumph, creates an immediate foundation of trust that can take years to build in other professional circles. The true engine of this network, however, isn't found in a digital directory, but within the local societies that dot the map. These organizations are the ground-level infrastructure of the Institute, serving as the bridge between your desk and the broader investment community. Joining a local society is akin to gaining a permanent seat at the table with the industry's most seasoned practitioners and its most ambitious newcomers. From monthly luncheons featuring world-class market strategists to informal mixers where the person checking in next to you might be a chief investment officer, these spaces humanize the abstract world of high finance. They turn a solitary profession into a communal pursuit, offering a sanctuary where you can discuss regional market nuances and global trends with peers who speak your language. Beyond the local chapter lies the vast potential of international conferences. the true global passport in action. Attending a CFA Institute event abroad is a masterclass in professional expansion. In these halls, the barriers of geography dissolve. You may find yourself debating emerging market debt with a portfolio manager from Johannesburg or discussing ESG protocols with an analyst from London. This is where the chartered prefix earns its weight in gold. It bypasses the friction of traditional networking by providing a verified credential of ethics and expertise. To navigate this network effectively, you must approach it not as a list of names to solicit, but as a diverse ecosystem to contribute to. By leveraging this worldwide membership, you aren't just looking for a job, you are joining a global guild that ensures, no matter where your career takes you, you are never truly a stranger. Chapter 23: Continuous Learning, the Post-Charter Professional Journey. The moment the final exam score flashes across the screen and the letters finally trail your name, a dangerous illusion often sets in: the belief that the mountain has been conquered. After years of sacrificial weekends and a monastic devotion to prep providers, it is tempting to view the charter as a permanent intellectual fortress. But in the high-stakes theater of global finance, the charter is not a trophy to be mounted on a wall. It is a starting pistol. It marks the transition from a student of the past to a practitioner of an unpredictable future. The day you stop learning is the day your analytical edge begins to dull in a market that never stops evolving. The financial landscape is notoriously allergic to stagnation. Asset classes that didn't exist a decade ago now command trillions in capital, and the regulatory frameworks governing them shift like desert sands. To hold the charter is to accept a lifelong membership in a guild of perpetual students. Staying sharp requires more than just meeting a minimum requirement of continuing education credits. It demands an obsessive curiosity about the why behind market anomalies and a willingness to dismantle and rebuild your own mental models. A professional analyst who relies solely on the curriculum they mastered 5 years ago is essentially navigating a modern metropolis using a map from the 19th century. True mastery in this field is found in the discipline of the post-charter routine. This is the quiet work of deconstructing new white papers, mastering emerging quantitative tools, and staying attuned to the geopolitical tremors that rewrite risk profiles overnight. The volatility of the markets is not just a risk to be managed, but a constant classroom. In the end, the charter proves you have the stamina to learn how to learn. Your value as a professional will ultimately be measured not by what you knew on exam day, but by your commitment to remaining an active, hungry participant in the never-ending evolution of global finance. Chapter 24: The Anatomy of an Elite Professional, Synthesizing the Skill Set. The elite professional is not merely a ledger of memorized formulas or a human calculator capable of instantaneous mental math. Instead, they are the byproduct of a rigorous synthesis, a blending of cold technical precision with an almost intuitive grasp of market psychology. To reach this level, an analyst must transcend the mechanics of the curriculum and begin to see the financial world as a living, breathing ecosystem. It is here that the mastery of quantitative methods meets the qualitative art of judgment, transforming a practitioner from a mere data processor into a strategic architect of capital. At the core of this anatomy lies an unshakable intellectual humility paired with an aggressive curiosity. The elite analyst understands that the most dangerous phrase in finance is, "This time it's different." Yet they remain agile enough to pivot when the data demands it. This mental flexibility is underpinned by an ethical backbone that isn't just about following the letter of the law, but embodying the spirit of fiduciary duty. They recognize that integrity is their most valuable asset. Once depleted, no amount of alpha can restore their standing in the global marketplace. Furthermore, the portrait of an elite analyst is defined by a unique kind of mental endurance, the ability to maintain clarity under the crushing weight of high-stakes ambiguity. While others might succumb to the noise of the 24-hour news cycle or the panic of a sudden drawdown, the chartered professional relies on a disciplined framework to filter signal from noise. They have synthesized the technical, ethical, and psychological components of the journey into a unified persona. a professional who is as comfortable dissecting a complex derivative as they are navigating a difficult boardroom conversation. This is the synthesis of the skill set, the moment where the arduous years of study finally coalesce into a singular, formidable identity. Chapter 25, Joining the Ranks, Your Future as a Charter Holder. The three letters that follow your name upon completion of this journey are more than a professional designation. They are a permanent shorthand for a grueling rite of passage. To hold the charter is to belong to a global fraternity that speaks a common language of ethics, rigor, and technical mastery. When you sit across from a peer in London, Hong Kong, or New York, the credential does the heavy lifting before you even open your mouth. It signals that you have navigated the same labyrinth of quantitative methods and derivatives, endured the same sunrise study sessions, and possessed the grit to see a multi-year commitment through to its conclusion. You are no longer just a participant in the markets. You are a steward of the industry's highest standards. As you look toward the horizon of your career, recognize that the true value of the gold standard is not found in the immediate salary bump or the updated LinkedIn profile, though those rewards are substantial. The real transformation is internal. The process of earning the charter rewires your brain, honing your ability to distill complex data into actionable wisdom under immense pressure. You will find that the discipline you forged while balancing financial reporting standards against the demands of your personal life becomes a permanent part of your character. This journey doesn't just teach you how to analyze a balance sheet, it teaches you the limits of your own endurance, and then shows you how to surpass them. Now, the path lies before you, and the only remaining question is when you will decide to truly own it. Whether you are staring down the daunting syllabus of Level 1 or standing on the precipice of the final exam, remember that every charter holder you admire once stood exactly where you are, feeling the same weight of uncertainty. The legacy you build in this industry starts with the decision to endure when others choose to retreat. This is your invitation to join the ranks of those who define the future of finance. The journey is long and the climb is steep, but the view from the summit is reserved for those who refuse to stop climbing. Take the first step, commit to the grind, and claim your place among the elite.